Alrighty, so welcome back, Brian, to part B of this session for episode 5 of the podcast. I'm going to quickly start off by giving a quick summary of where we left off. So what we were talking about is in the prior session, there was an opportunity to high grade the asset quality as a byproduct of you guys being in a really advantageous position coming into COVID. Along with low debt rate, and you guys have been able to execute strongly on that as a byproduct, have transformed the company. So just a quick, for our listeners that may not be informed, coming in, you guys entered 2020, about $400 million market cap, 20% debt to total capital, and 24,000 barrels a day, and have come out of it 2.5 billion market cap, about 38% debt to total capital, with about 63,000 barrels currently producing. So just a huge, significant transformation. And then what we're going to do is we're going to now break that down and discuss maybe the thought process of making that transformation, a little bit of the details of the key acquisitions that were made. And then what we're going to do is we're going to talk about the enhanced oil recovery, as a part of your 3 multi-legged stool. And then what we're going to do is we're going to talk about that major once in a generation, your words, Brian, acquisition. And then we're going to touch base on divestitures, and then call to action, why Tamarack today? And then we're going to wrap it up and take it from there. So that's what we have currently on the menu. I started off with a brief summary here, and then I'm going to pass it off to you with the first question. Here is, going into 2020, you guys had amongst the best balance sheets of the companies at the time. Was that by design? You guys had limited acquisitions since the inception of the company in 2010. You guys grinded slowly, and it seemed like you guys were just waiting for the ideal time, found it, and were able to capitalize on that. So I just wanted to just pass it over to you, and then maybe you can talk a little bit about how it is that you founded yourself in such an ideal position coming into COVID, or perhaps maybe you had a different macro outlook of the commodity. So I'll just pass it off to you here, Brian. Nice to have you back again for the Part B session, and if we can just begin right from there.
Yeah, and thanks, Sohaib, for pulling this together. You're doing something quite unique here. That's quite, I think it's quite special for investors. You're digging a little deeper, and asking questions. And I'm not giving you a canned presentation. I'm giving you kind of the way I see it from the heart here. So I think I think you're providing a product here that your viewers and listeners are going to be really appreciate. In terms of the strategy in 2020, there was a couple of key events. It was still very much a seller's market in terms of M&A. There was still a sufficient, even though
Brian, just to get in, I was just talking about from starting the company leading up to, ending to 2019, you guys had a very, very superior balance sheet going into that.
Yeah. And so, I think there was always some signs of a little bit of trouble, even before COVID. So, in that late 19, we started to get pretty worried about the market. And before that, we were an acquisitive company. We always seemed to be a little bit short of inventory. And I would say equity investors were relatively short-term focused as well. We were starting to get some pressure on in the market for consolidation. And in a down market, that's typically what you see is investors wanting to see more consolidation in the market. So I think you and I, Sohaib, have talked about you eat or get eaten at some point. And in 2019 we thought we would grow, but then when the market turned, we started to hunker down and play a defensive position. So coming in January of 2020, pre-COVID, we had actually seen the market get a little bit tougher the supply of and storage of crude in the market was significant. There really wasn't a bright spot that would say that oil prices were going to move to the positive, and a lot of downside headwinds. So we became quite concerned. We took that concern to the limit of getting some hedges in place and significantly trimming back capital spend. And we had spent a good deal of money in the veteran water flood. We knew that we were going to get a response, and we ended up hedging. I think it was something around 50-60% of our oil hedged in January of 2020. So we felt we had the company in a pretty good position to weather a downturn. No one knew COVID was coming. Like, couldn't have predicted that one. But we knew a defensive position was the right thing to do prior to that coming in, just because we could see oil be down in that 55, 50, 45 range. So with that defensive position, then COVID hit, and then that became all that much more important, and there began to be quite a differentiation between companies based on balance sheets. And I remember at that time actually getting calls from peers wanting to merge with Tamarack because of the hedge and the strength that we had in our balance sheet. But you couldn't really merge because you were taking on their debt. You were fixing your suitor's problem. But really, what was it going to do to Tamarack shareholders became the issue. So despite shareholders really wanting us to consolidate, I just couldn't consolidate with people who had companies that had bad balance sheets, and there were some really bad balance sheets. There was fear that we were going to lose a number of companies to that when oil, of course, hit the $20 and $30 range, and COVID really hit. Now, at the same time, we started to get some build on, by the time June, July hit that year, first year of COVID, we were starting to get some pretty nice response in the veteran water flood. So we didn't have to put capital in to, keep our production where we needed it. And we had these hedges kick in. Gosh, we thought about selling those hedges. I mean, at one point those hedges were, I think they were worth something like $90-100 million or something like that for the hedges. Of course, the banks wouldn't let you sell them anyway, so you had to hang on to them.
Yeah, so that makes sense. And you were saying it's predominantly you were in a position where you couldn't really be able to sell those hedges. And was that thinking of selling the hedges so you could be able to start making some acquisitions and taking advantage of the sell-offs that was taking place?
Yeah, I think it was you bet, to get your pay down debt, and we knew assets would be coming our way. And we thought that oil prices couldn't stay there for the amount of time that most folks were looking at those hedges. So it would have been a good bet, but we couldn't have done it. Nevertheless, they did help our cash flow right through to the end, and when those hedges were done, a lot actually, and we did very well by having those in place. So I think the fortunate thing for Tamarack, you like to say it's your smart business savvy that got you all these things, but as you know, say, so much of this business is luck. And then when you get lucky, how do you take advantage of it? That's a bit more of the story there.
Yeah, and at one point you were even telling me that there were $100 million in the money, these hedges. Yeah. So it was and then go ahead.
It was pretty significant. So and I think if you actually took at the total value of those hedges, they weren't worth $100 million, because oil prices did recover and come back up to something a little more reasonable. But what it did do is it really that gave us some breathing room to really think about what kind of assets we were going to be in, and how our existing assets were performing. I completely, over the next, few years from COVID, pretty much, there was a lot of executives that had retired, and I wanted to bring a lot of youth onto the team. And if pretty soon, that youth really does pay off. You're good to have a certain amount of attrition in the executive, and resetting the new strategy with a new team was going to be pretty important.
Yeah, this is it's interesting because you talked about how that time allowed you to reassess the going forward of Tamarack and where you would like it to be, and then those prudent hedges have allowed you to be able to take that step back and redirect. I remember seeing old clips where you mentioned this is from years back, I believe it was 2018. It's incredibly prudent to be disciplined spenders in a down market. Curious to hear if that's attributable to maybe your experience with Apache and working with such a large company and being able to weather multiple downturns. I think in 2018 you'd halted your drilling program to zero. Again, it's an example of being able to respond nimbly to the commodity market as opposed to just drilling yourself into oblivion.
Yeah, it's a good point, and you're right. So we definitely learned that. I definitely learned that at Apache. They used to have a term called sense of urgency, and when those guys saw headwinds coming, boy, they pulled back hard. You could be in the middle of something, and they would, your capital program was just slashed. What did you bare bones have to do, right, to get your operation going? And all that discretionary spending was all the drilling cut, and they believed that you were, that was necessary in order to take advantage of down market supply chain management issues and take advantage of M&A markets that interestingly enough, people sell in a down market, and because they're getting forced to, and banks are putting pressure on. And we saw a number of our competitors with balance sheets that were already stretched going into it. So we knew that there was going to be a lot of pressure in the market. We knew that if we were going to retool and bring in new assets, this was going to be the time that we were going to be able to do it.
And I think what's even interesting too is that the commentary about this company has always been it's one of the E&Ps that have been returns focused, return centric, and that may have allowed you to maybe grow at a slower rate than your peers. But part of being returns focused is prioritizing the shareholder first, as opposed to top line or growth numbers. Could you talk about maybe how that challenge that could have resulted to a slower rate of growth in previous years help set you up in a position where now you could leapfrog during that moment of time, that pocket of time that creates the opportunity for you to be able to do what you did, what you mentioned, which is being able to buy the distressed assets?
Yeah, there was a time, I'd say that time from, say, 2013 to 2019, somewhere in there, when there was still a lot of equity coming in the market, even though the returns weren't there. And what happens then is you can be a rate of return focused company and return to shareholders. And what it means in those environments is you're just not going to get the bid. So you either end up overpaying for assets, which catches up with you, or you just don't get the growth. And in our case, we just didn't, we were getting beat out of bids all the time. And interesting enough, a lot of those companies that beat us out on the bids are all gone. They all blew up and they're done. And there's people who invest in those because they're momentum stocks, and an investor can get out before the thing collapses or at the right time and not ride it all the way down. So investors have a bit of an option, but for a lot of those companies that in my opinion, overpaid for assets and weren't value focused, they're just gone. So you have to get into a time where it's a buyer's market, and 2020, 2021 became a buyer's market. If you had a decent balance sheet, there wasn't equity pounding into the market. You were going to do it with your balance sheet, and it became opportune to rebuild.
So, Brian, so markets move and you got to move with it constantly. So you've got to respond to capital markets. And the big thing I've seen with commentary is, Tamarack needs size. Can you recall, speak a little bit to that, which is even going back to 2015, the commentary even back then was there's a reduction of appetite for juniors. So the pressure from 2015 all the way coming up to 2019, coming into 2020, that's 5 years of pressure, which is grow, so you could become material for institutional shareholders. Could you talk about a little bit about that, where there was that shift from growing to size to being more meaningful to?
Yeah, and I think there was energy. If you look over that time frame, the number of energy investors and energy funds dropped considerably. And the ones that were left, if you were in an ETF, you had to be a certain size in order to qualify for ETFs. And once you hit that size, then they had to buy you, because it was, they were passive funds. And so as long as you got that size, you were golden. And you may recall a number of those fell below the market cap and they got kicked out, and then the ETFs have to sell. So it's an interesting dynamic, and one that, when we did our strategy, we looked at that and said in 2020 and said, you know what, the equity markets have changed so much that there's not the energy specialists. There's longer term investors that are looking for longer term plans, long inventory. They want to compare your sector to another sector. And that's where we really took the shift and went to metrics that were more longer term, medium and long term focus, not as much short term. So let me give you an example. So Abe, if you take a Viking primary well, great rate of return, great payback. And we used to say less than a year and a half payback, you're golden. And when you look at that, there's an investment where you can get a lower rate of return, but a higher profit to investment ratio because it has lower decline. And if you're longer term focused, then you're going to be looking at those profit to investment ratios. How many times does an investment pay out as opposed to how quickly? And it's always going to be a bit of a balance. So, hey, because you have a balance sheet in the current year you got to manage. But the companies we looked at in the strategy that were longer term focused had good PIRs on their investments. And that led us down the path of, okay, if you're trying to maximize debt adjusted free cash flow per share, then what kinds of investments maximize that free cash flow for shareholders on a longer term basis? And we found quite clearly that the ones that had the highest PIRs, that was the key driver on long-term success.
So, can you explain to our viewers that maybe some of the retail following that may not be very familiar? So this debt adjusted free cash flow per share. Could you explain to them why this is more meaningful to them and how this is opposed to years prior to, I'm talking about 2013, 14, 15, what was being in focus then versus what it is now, and how this is much more meaningful to them than the way the business was conducted previously.
And certainly, so hey, the focus was growth then. People were getting paid on the growth numbers, and there wasn't as much attention paid on longer term investment. But when you look at debt adjusted free cash flow per share, I mean, what aligns to shareholders? That's the question we asked when we did the strategy. What aligns to shareholders? Free cash flow, right? That aligns, and you have your maintenance capital for sure. But the less your maintenance capital is, the more free cash flow you generate. So we were interested in, that's what these, higher profit to investment ratio projects, how many times is the well paid out? If you think about it, that's what's driving free cash flow, is because you put a well in and it keeps paying out. Clearwater wells pay out 5 and 6 times. 5 and 6 times. If you have a horizontal multi-stage fracked well, the payout period is pretty short, but it only pays out once, maybe twice. So that longer term investment payout multiple times is really what builds a company. So when you look at, the reason we debt adjusted. So if I said, okay, I'm going to give you a 5-year plan, and my goal in that 5 years is to maximize the free cash flow. Everybody can relate to that. Every shareholder can relate to that. What could possibly be a better measure than the proxy of profit? It's essentially profit. So how much do you generate over that 5 years? Now, if I go into debt, I can drive more free cash flow. I can borrow money, drive my debt up, generate free cash flow, but then you're kind of cheating. You're generating. So we did not want debt to influence our decisions. We didn't want to go into debt in order to make more free cash flow per share. So we call that debt adjusted. And all that is you're taking your per share numbers. When we say free cash flow, let's divide it by the number of shares, because really that's what shareholders are interested in. And let's debt adjust it so that you have an apples to apples comparison. And so basically you buy or sell your stock in that calculation in order to take out the effect of debt.
And so that being addressed, the other element too, I would say at that point in time, I mean, even Eric from 9 Point was at Market Call, and he was talking about how this company either needs to grow or be taken out, one or the other, and how their current size isn't going to be able to attract the type of investors and investment necessary. And then you go out and you successfully execute and you conduct the acquisitions to be able to get you there. And then you end up with retail investors throwing a hissy fit. Oh, these guys are just acquisitive guys, and they keep. So it's like catch-22. Damned if you do, damned if you don't type of thing. I just wanted to bring that up because you see that everywhere. So it's like, which one is it going to be? For so many years, the pressure was to be able to get to above $1 billion market cap and meaningful. You guys have been able to execute and do that. But then you've got some disgruntled retail.
And a couple of points. I wished I had more retail in my shareholder mix. I don't have a ton of retail. I have mostly institutional relative to my peers. But you're right. And when you look at it, so hey, everybody has a different motivation that could be in your stock. And, as a CEO, you have to kind of see through some of that stuff. You're going to get criticized. And if you look at when we went out and bought the Clearwater, people scratch your head and said, geez, that's not Viking Cardium. They're off strategy. What's going on? Even though we kind of articulated where we wanted to head to. And then when we bought Charlie Lake, everybody's just said, well, these guys will just buy anything. It looked to the outside like a strategy that wasn't well thought out or put together, but it was very deliberate and quite meaningful. And we were simply going over, if you look at the chart and look at the profit to investment ratios per play, the Clearwater's the best. Martin Hills, Nipisi, the best. And Charlie Lake is I think Charlie Lake was like third place at the time. I think some Frobisher open holes were in the middle, but Charlie Lake was the second best. So we went after it, and Charlie Lake actually had the lowest break even. And in order to manage risk in a company, you really want that break even price as low in your entire company as you can. And you can see, my guess is we're probably $7 or $8 break even less than the average. We're I think somewhere around $36, $37, and that includes the dividend. So that means that shareholders don't need to worry. If prices get down, that we still have our dividend baked in at that low break even. So it was important from a portfolio strategy to get over into those plays that had the highest, we could deliver the highest profit to investment ratio, and therefore the highest free cash flow to shareholders in as defined in debt adjusted free cash flow per share. So we took some body blows in that, some criticism in there. But so, hey, you're always going to have investors pulling different ways. And, in some cases, even you look at myself, I can't really sell any stock. I'm in it for the long term. I don't get as worried about short-term stock price here or there because I'm fixed on creating long-term value. And now we're showing you a 5-year plan. And that's what I'm rewarded for. That's what my compensation is set on is 5-year debt adjusted free cash flow per share. It probably aligns with longer term shareholders more than it does short term shareholders.
That's really good and important for the guys that have maybe a little bit of a longer time horizon to understand and appreciate.
Mm-hmm.
I think at this point in time, what I wanted to do is just touch point on some of the acquisitions that were made along the way before we get to the major significant one. So in about since 2010 and 2017. 18, I've been looking. You guys have been able to do about 5-6 acquisitions within that range. And then between 2020 onwards, you've done about 7 to 8 acquisitions. So what I wanted to do is just quickly touch point on a couple of these acquisitions and talk a little bit about them before we approach that once in a generation acquisition, and we'll spend a big chunk of time there. So if we can perhaps start off with, I think one of the first acquisitions you did, which was buying one of Surge's best assets, the iHill, that iHill Sparky asset. If we can talk a little bit about that, how that came to be, and what you're excited about that, and then we'll move on to the Epicity Acquisition, Woodcott, and so forth.
Yeah. So the that one, if you look at that particular acquisition with iHill, there was some Clearwater acreage with that. That came with it, but the key asset was iHill. I think it was producing at the time around 1,700 barrels a day, somewhere in there. It had a few drilling locations left. Not if it was just the drilling locations, we wouldn't have wanted it. But the 3 legs on the stool for strategy was going to be Charlie Lake, Clearwater, and waterfloods. And so we had a collection of waterfloods already, Penny Veteran, and adding iHill in the same area there made a lot of sense. So we took a look at that, and basically I think we took the water injection from somewhere around 2,500 barrels a day up to 12,000 barrels a day. We drilled source water wells there. We were able to put those on, and get the production up on a water flood relatively fast. Now, interestingly enough, when you look back at the acquisition, we paid out the acquisition and all the capital investment will be, I think, somewhere around a 2-year payback. That's just phenomenal. Like, it's just one of the, in that whole time period, even though we were focused on Clearwater and Charlie Lake, bringing those assets in, this was probably the best deal that we did from an M&A standpoint, was bringing this one in. And it's responding very well. I think we're up to around 2,500 and in production still growing. Great response on there.
From 1,600.
Yeah. And it's still building. So, we're real happy with how that's responded. And water floods are long life reserves. They don't kind of flash down at a 40-50% collapse rate. So your decline rate. So basically on a debt adjusted free cash flow per share, that's a real win for shareholders on that asset.
And then if we can touch point, the next acquisition was the Epicity acquisition. So just a couple of points on that one.
Yeah, so there was a number of smaller players that were in. I won't pull up names here, but one player, private, in a little bit of bank trouble. We picked up the acreage in a non-op position. Acreage in Nipissey and a little bit of acreage in the Jarvie area. But non-op. So as soon as we picked up the non-op, we went to the operator and asked them if they'd sell. And the operator, we ended up buying the operator too. So you got the non-op fairly low cost because nobody really wanted a non-op position. We certainly didn't, but we were able to pick up the operated side of that right after. And then we were a player, and there wasn't much competition for the non-op side of that. So got that for a good price. Then when we ended up drilling it, I think the wells in there were somewhere around 150, 160 barrels a day. And we bought another package to the west of that in Nipissey. Bought it with wells that were drilled and not put on production. We put the wells on and they were 300 barrels a day. So we hit a real nice pocket of good viscosity, lighter oil that moved through that reservoir much easier, and you got that better production rate. And that's where we implemented the water flood, was where you have that good API gravity. So that was a real win in that area. It was incredible. I think last year, in these numbers, I could be a little off because I don't have them right in front of me here, but I think we invested like somewhere around 100 million capex in Nipissey. We took production, I think almost doubled production in the area, and we returned about 100 million in free cash flow out of there. Maybe it's 80 million bucks in free cash flow. Wow. It's incredible to grow. Usually when you invest in an oil and gas opportunity, you got 1 or 2 years where you're sinking capital and you're borrowing from somewhere else to pay for the growth and the assets you have to put in. And here we're spending capital, growing production, and returning to shareholders at the same time. That's a phenomenal high quality asset that you're going to try and go after all the time. And
then that takes us to Negita. Negita was a very significant acquisition for you guys. Could you talk a little bit about that and what intrigued you guys and what got you guys to transact?
Well, I guess the one thing that we really liked about that, it was that low break-even cost. I think when we looked at that, break-even was somewhere around $22 a barrel. There's nothing. And according to Peters and Co., that was the lowest break-even price in North America. So high quality asset. It's a mixture of conventional and unconventionals in the carbonate. And you have lighter fracs. You're just getting rid of near wellbore damage as opposed to let's say a Montney or a Duvernay where they're massive fracs. And you get these little pockets of conventional in there. And some of this stuff was even water flood in that area. We're probably going to initiate a little water flood up there in a pilot in the Charlie Lake. So it's a conventional, more of a conventional type reservoir. I think some people shy away from it because it's not a blanket play that you can, it's not an unconventional. You can just go forever. So you have to pick your spots, but there's lots of well penetrations to map things and know where you should be drilling, where you shouldn't. It's an immature play, which means like the Clearwater, the wells are getting better and better. Charlie Lake, they're getting better and better too. I think there's a slide in my deck that shows the wells improving over time. So both those plays are relatively immature. There's many different layers in the Charlie Lake. So again, feed that into a 5 or 8 year debt adjusted free cash flow per share plan, and that play works wonders. Those wells work wonders. And when you think about it, Sohaib, you got to really be careful and strategic with your M&A now. So shareholders should realize that with Tamarack, that I can only do an acquisition. I've got to take it to my board and show them how we are going to win on 5 and 8 year debt adjusted free cash flow per share. So that means the quality of wells and assets that I bring in has to be at least as good as what I've already got. Otherwise, I'm going to dilute that metric. So as a shareholder, I think you'd be happy with that discipline, that I can only bring something in that's better. I can only, that's the only way that you'll win on that metric.
Yeah, I regularly see Charlie Lake on that top ranking of best wells in the Western Canadian Sedimentary Basin. It's really top notch, and I think even the guys, they didn't want to sell it, but again, situations created that environment where some people were forced to sell and some people were at the right place where they were able to buy, and now the shareholders have become the beneficiaries of that. The follow-up question I have for you for Charlie Lake. Could you discuss maybe the purpose of the Wembley gas plant as like the decision to do that in terms as opposed to going through third party? I'm guessing probably maybe autonomy, more control, but I'll leave it up to you and you could discuss a little.
Yeah. So where we're at in Charlie, well, let me just finish off on the M&A,
Sure.
Sohaib, and then I'll move on to the plant. When we do that 8 year debt adjusted free cash flow per share in 5 years, we do it at $55. Okay. So shareholders can take great satisfaction that I'm running some low prices when I do these acquisitions to make sure they're accretive to the company. Now, the only way you can make those things accretive is if you have really good inventory, because there's a lot of plays won't work at $55. Like, it's really tough, especially some of the deeper high cost frac plays don't, they just can't work at that price. So that's a pretty tough screening grid. Now, with respect to the Charlie Lake and that in that particular area, there's so much Montney gas coming on in that area. And if you remember Blueberry happened, well, guess what? Everybody moved to Alberta and drilled on the Alberta side. So there's takeaway capacity there. You've got Alliance and TransCanada out of there. You don't have a lot of other ways. You have to figure out the way to get it out. Of course, once you get gas to the West Coast, that could change that picture. So you got to get your takeaway space, and you have to get your processing space. And Anegada didn't have its own gas plants. It owned a portion of some plants, but it didn't operate any of its own. And so when Montney gas came on, you can get squeezed out if you're not careful. Plus reliability. There's, you want to own your own stuff. You want to control a meter station. So you get your reliability up. There's a huge win for Tamarack on reliability by owning its own gas plant and putting it up there. And then the other thing is that was pretty low cost. It was a surplus plant for us. So we moved it from Cowley, Alberta, and moved it up there. It was significantly underutilized there, and moved it up. So now the more we can get our own capacity or P1 service in someone else's, the better reliability, and the more we can control our destiny. We also took a good portion of sour space. Doesn't make sense for us to build sour plants. They need to be so much bigger for economies, but it does make sense for us to pull the sour in.
And when you say pull the sour in, what do you mean by that?
Let me back up. Yeah, so there's Charlie Lake gas that's sweet, and then there's some Charlie Lake gas that's marginally sour. I said, just a small bit, but it has to go through a sour plant. There's economies of scale in sour, so I don't think you'll see us building our own sour facilities there. But we will participate and took capacity in plants that are going to be built in the future there. Now, it's one asset, Sohaib, where we have way more inventory than what we can possibly bring on in 8 years. And it's important for viewers to know our current strategy in bringing production up. That I don't want to just bring it up and then have it fall down in my 8 year plan. So when we look at bringing it up, we look at the 8 years and we bring up the whole 8 years, so that we're not chasing our tail on everything. And after the 8 year plan, I think we had something like 60 to 70 wells left over, and we're still adding more Charlie Lake wells every year. So it's pretty clear that if we wanted to take production up in the company, that would be a good area because we have so much inventory, we need to take it up and utilize it more. I think we bought that I think the day we took that asset over, we were somewhere around 8,800 barrels a day. I think in the first quarter, we're somewhere around 16,000 barrels a day. And currently with this plant we just brought in, we're higher. In fact, I think we've hit some peaks, and this isn't an overall quarter, so don't take this number and run with it. But I think we might have even hit, a little over 18,000 here just recently.
So you guys more than doubled production.
Yeah.
Wow.
Yeah.
And then the other thing I wanted to talk about is any delays, material cost, service inflation. You said you brought the plant from somewhere else, so probably you didn't have to deal with material inflation, but probably services inflation.
Yeah, everybody's so worried about supply chain issues at the time. And I think everyone's still worried about that, plus equipment inflation for sure. So if you're way better to get used equipment if something works, and if you can't buy it, if you don't have it yourself, then go get it somewhere else. And we're always shifting things around, moving around, taking care of it that way.
And how long has this taken to build, and was a decision made to build it right away? And then how did you guys approach in prioritizing this build out of this plant?
So we made the decision last summer, because what was happening, Sohaib, is that we bought the initial assets, and let me give you a little bit of color there on where your roundabout numbers, where are you about to invest. So if you look at an acquisition, and typically our profit to investment ratio is about 1.3. So you get your money back plus another 0.3. If you do tuck-ins in existing areas, and this is run at the $55, and if you do tuck-ins on existing areas, you're probably going to get PIRs of in around the 7. So you can buy small, 1.7. So you can buy smaller, some of the company might sell you some wells and some land and a little bit of facilities, and the PRs and those are around 0.7. And then if you just drill wells organically, you're probably around 2.3. So 1.7 to 2.3. And then if you do enhanced recovery, or let's go the Clearwater primaries, you're probably around probably 3 to 4 times, and water floods are around 3 to 4 times. So the name of the game is to probably buy these assets, try and do some tuck-ins and land sales and bolt-ons after, and then build your inventory that way. So we have significantly more inventory in the Charlie Lake than when we bought Negita. And that's higher profit investment by a long shot.
It's a byproduct of that tuck-ins that you mentioned.
It's the follow-on, yeah. The crown land sales you pick up, the lands you buy from others, and that usually comes from extending wells. Maybe the average was 1.5, and now we're drilling up to 3-mile wells. So you get a lot more profitability on those because of those extensions. And so it's a great area. It's a really good, highly profitable area.
So that makes sense then, the decision to make a plant, because we plan to really develop this core area. Could you talk about how this plant is going to accelerate the Charlie Lake development?
Yeah, so I think we end up picking up like a number of the processing agreements we had there, Sohaib, were shorter term. So you might get, a year or two of a Montney player that's in the area, and then he intends to drill it. So eventually some of these contracts we were going to get squeezed out. So some of that plant capacity is just used to replace those shorter term processing contracts. And then another part of it is for inventory that you brought in. So I think we've got 4 wells that we drilled into this gas plant that were on test this weekend, actually, fracking and flowing back right now, that are going to take advantage of that capacity, and we'll be able to pick up more volume through that. And then that plant is expandable. It's 15 million a day plant capacity, easily expandable to 30. So over time, we may look at some plans to pipe some gas, some more gas down there, or acquire some other processing capacity somewhere else. But you know, the reason we need capacity is there's just so much inventory, and then at the same time we have to tie up transportation for that as well. So it's a real balancing act there.
And you did mention that there's more than 8-year inventory.
Absolutely. Yeah, there's probably about 12 years inventory there. And we're still at it. Yeah.
So sorry, I missed it.
And there's probably about 12 years of inventory there, and we're still adding inventory.
Wow. And then if we can talk a little bit about Crest Wind and Rolling Hills, right before we transition to talking about EOR.
So if you look at the Clearwater play itself, the highest rates are coming out of Peavine. I think the longer wells there, some of those wells are 1,100 barrels a day. And then you get into the longer recovery and thickest zone is going to be in Martin Hills. So you're, say, 25 meters thick. The pay there, phenomenal. It's unbelievable. I don't know that there's anywhere else in Clearwater you get those kinds of pay thickness. Then you get to Nipissing, you're about 8. And then you get into the Jarvie area, you're probably somewhere around 4 to 5. So that gives you some perspective. In the Seal area, well, first of all, Martin Hills, you can have up to 60 million barrels of oil in a section, oil in place. Phenomenal resource in place. Seal has about 50 to 60 million barrels in place, but it's in 3 different zones, 3 different BC and D sand. So it's not all contiguous. And so you know, in all these, you know, by anyone's definition, there's just a phenomenal amount of oil in place. Contrast that to a Cardium, where you might, let's say, 4 meters thick, because there's lots of people drilling 4 meters thick. You're about 4 million barrels of oil in place in a section. So that gives you some idea of why the Clearwater is so good to go after for primary and secondary recovery, and why it's longer life. You just have thick reservoirs.
And then Rolling Hills?
Rolling Hills and Crest Wind, and we bought an asset down there with Spur. They're all in that same 4 to 5 meters thick. The oil is a little bit heavier there. You're around 14.5 API. So I would say, relative to those 3 other areas, Nipissing, Martin Hills, it's a lower grade. But it looks like, you know, we'll be trying some different technology in there to increase recoveries and drive down costs. And I'm pretty excited about that, because there's a lot of inventory that we have down there. So we'll be trying that technology here coming up here in the next month or 2. But we're very excited about that.
So Brian, so far we discussed the Charlie Lake, and we discussed the Clearwater, with the exception of the Delta Stream. What's remaining from the 3-legged stool is enhanced oil recovery. So I just wanted to start off the enhanced oil recovery discussion with maybe you can give an explanation to our viewers that are not familiar with this recovery scheme, water flooding.
Yeah.
And why it's such a meaningful form of oil extraction.
Yeah, so and probably in the context, I'll just kind of start off with the Nipissing example, and then you'll get the context there. But in when you do these large reservoirs with a lot of oil in place, and they're not water drive, and they have low GORs, low gas oil ratios, you start to lose the drive mechanism pretty fast in those reservoirs. So that's why the recoveries are, say, only around 4.5%. And as opposed to a conventional reservoir, light oil reservoir, that might be, you know, maybe 10 to 15% on primary, or 10%, maybe double. So when you don't have that, when you lose pressure and your oil is fairly viscous, you lose the drive mechanism to get it through the reservoir into the wellbore. And so, you know, a lot of people will call these water floods, but in a way, they're pressure maintenance schemes. You're basically just putting water into that reservoir to keep the pressure up, to allow it to flow better into the producing well. And so the results are actually quite amazing, because it's a relatively simple process to put pressure in. You just pumping water in, and you don't have the complications of a lot of other reservoirs that you might otherwise have. So, you know, we think we can take recoveries into that 10.5% quite easily with water flood. Now, just imagine doubling the recovery from an already massive oil in place field. It's incredible. So longer life, there's going to be a lot of things to do here too, and we'll be adding reserves year in, year out with water flood as we go forward.
Brian, this sounds like these water floods are going to add a material effect on your reserves. If you can only initially recover 4% and you can get that up to 8% or 10%, that's more than doubling your reserves. Is that a correct way of seeing it?
Yeah, that's right. Yeah. And you know, so hey, here's the trick though. I get measured on 8-year debt adjusted free cash flow per share. So if you make investments now, you better get them in there. Yeah, it's the success or failure of these water floods. I believe it won't be. I know there's a lot of people worried about water breakthrough, and you're going to have water breakthrough. But I think that's good. The real success here is how fast can you get response, and then you get that in that 8 years, more profit for shareholders in that 8-year and 5-year debt adjusted free cash flow per share.
There is
so, so if you look at the Nipissey water flood, we initiated injection right off the bat. We didn't produce all the wells for 3 years and then convert them over into water after that. I don't think that's the right answer. We can put water in the ground right away. So primary wells come on, produce them for 4 months, drill the injectors underneath. They start injecting right away, you know, say 4 months after. And then we get a response another 3 months after that. That's just an amazing water flood performance that's going to do really well, as opposed to, so hey, what you might be aware of in the back, you produce the wells, you drop the pressure way down, and then you got fill up time to get your pressure way back. It's just too long. You need paybacks that are better than that.
And that's, I think, in what for our viewers, what Brian was referring to is the tuning fork method pilot in Nipissey, where you guys were able to increase production from, I was seeing one of them from about 190 to 300 barrels, and then the other one was 250 barrels a day to 500 barrels a day. So it is, I mean, absolutely amazing in terms of the significance of the contribution to increased volume that it's been able to add.
Yeah, it's you know, the fluid, because there's not much gas there, it's not very compressible. So you get the response. You put water in the ground, you get a response relatively quickly, and that you know, a number of my peers look at that water flood, and certainly we do, as a tremendous success. The real trick here, Sohaib, is to, like, the primary economics are so good that you really need to do a good job of designing these floods, because the idea is to make more profit than the primary, and you can do really well on primary here too. So the trick is to keep your production coming out, and yet give the enough space to do water flood with your between you know, the legs of the horizontal wells. So we end up clustering a 9-leg horizontal, and we cluster 3 legs quite tight together. By anyone's standards, they'd probably look at that and say you're going to get interference, which you are under primary. But when you support it with a water flood injector, then you lose the effect of interference that the primary would suffer, and get your recovery up that way. So we're quite pleased, and we've got a number of injectors that we're putting on now from our winter drilling program to enhance the water flow.
Bruce Gamble, in one of his BNN segments, discusses how water floods are like a manufacturing operation. Last time I've heard that was when in SAGD, where they're injecting steam into there. So is that a fair comparison in terms of, you guys are just using water, those guys are using steam, but the decline rates are very similar. They're very, very low, and you get to produce for a very long time.
Yeah, so and ours is more of a pressure maintenance scheme than like a true water flood. I guess is semantics, but what you're really doing here, the pressure is dropping because you don't have much gas and it's not a water drive. So you just start to run out of pressure. You're not that deep anyway. It's not a lot of as much reservoir pressure as some reservoirs. So just by putting water in, you're keeping the pressure up. In the case of steam, you're not only keeping the pressure up, but you're actually changing the viscosity of the oil by heating it up. So the recoveries are going to be much better on the steam side, but it's just a cost and energy, GHG issue with all those that you have to be cognizant of.
Now, Brian, your team has done a lot of water floods before. You've executed. Typically, my understanding is the companies will buy asset that's already water flooded from some of the larger guys. But you guys have initiated a lot. Could you talk about maybe the expertise that's built within your team that have allowed you guys to really focus on initiating your own programs?
Yeah, so when we did that strategy review, we had some water flood expertise because we already had Penny in house and we had veteran, but we really needed to, I'm a believer successful companies get involved in 2 to 3 plays, and they become experts in that play, and not experts in everything, and try and do it that way. But the 2 or 3 you need to be industry leaders in, and so certainly when it came to water flood, we wanted to enhance all the water flood skills we had in the company, especially water flooding and some of the heavier crudes. So we did bring in a lot of different water flood expertise into the company, top talent that we could find. It's very difficult to find. That's an old technology that it's everybody's drilling horizontal multi-stage wells and fracked wells, and so that technology is, the water flood technology is hard to find, but we have a really good core of water flood expertise built in right now to design these floods.
And we looked at iHill. You guys went from 1,600 to 2,400. The other ones went from 190 to 300 and 250 to 500. Do you see these results being repeatable, or do you see this as could be potentially maybe an outlier in terms of the results that you guys have gotten?
Well, it's a bit of a, typically conventional reservoirs are relatively small and not that extensive, but certainly the Clearwater, is a conventional reservoir that's very extensive. And I mean, we've known that's been there for a long time. So hey, it's not like we have a ton of variability in pay thickness or sand quality. The variability is going to be in the API gravity, and so and that makes quite a difference on sweep. So it looks like we've got a lot of runway in the west side of Nipissing, and then you get a little bit heavier, and as you're going east, and then you get light again in the eastern part of Nipissing and West Martin Hills. So there's lots of water flood area there, lots of like 18 to 20 API stuff where you got sections of land, and they're going to respond like Nipissing. So yes, there will be a lot of repeatable plays, and just one section of high quality section, you're going to get a lot of recovery off that section. If you're say 40-50 million barrels in a section, you get, and you're getting in that an extra 4 or 5%, that's pretty significant. And there's a lot of sections. So there's a lot of runway we have way more dirt that we could water flood than what certainly any kind of capital plan we have in the 8 year. Let's put it that way.
And I heard from somebody, I don't know the accuracy of it, but with these open hole multilaterals, there could be a risk of, the reservoir collapse with the pressure management where you guys are injecting water
Yeah.
straight away. Do you see that that could potentially be a successful mitigation of that potential risk, or is even that risk maybe an exaggerated sense of risk to begin with?
Yeah, I think everybody really worried about it. So hey, on collapse, and I think there's been like 2 or 3 examples of where holes have collapsed, and typically people know that there's reasons for that. While drilling or something you did while drilling, or you might be in an area where you're just super porous and it's not consolidated anymore. But that kind of risk is few and far between. Like it's not something that hits the radar with us right now. And one of the things we're doing is enhancing the injectors by drilling multi-leg injectors. And as you can appreciate, you're right close to the heel, the water can just bypass and go to the producer. So we're actually drilling down into the tighter stuff and then coming back up and putting your water flood injector. So we get the low cost of a multi-leg injector without the risk of bypass. So we're working with the permeability of different zones to design these water floods cost efficiently and manage risk.
So this concludes the part B of our 3-part series with Brian. We started off by discussing how Tamarack looked like coming into the sell-off, the COVID sell-off in 2020, the critical decision that was made by Brian to shift his business plan on a 5-8 year debt-adjusted free cash flow per share basis, and the type of assets required that would allow this new strategic shift that they have been able to shift to. And once they've done that, talk about how they've been able to execute on the acquisitions along the way to create the 3-leg stool, as Brian likes to call it, which is their Clearwater acquisitions, which we've discussed, the Charlie Lake acquisition, and then third, which is the third part of focus, their enhanced oil recovery, pressure management, as Brian likes to say. Once we've been able to do that, we have left the mega once in a generation acquisition left to tackle on its own for the third segment, segment C. Segment C would include the Delta Stream acquisition. 9 months later, what does Brian think about it? How the integration is coming along? And then we talk about assets versus divestitures. What are we most likely to see going forward from here? Then we wrap up the discussion with we talk about the action plan, like where do we go, why Tamarack, and why now. This includes the shareholder return strategy. And then we wrap it up. That concludes segment C. I would just ask if you enjoyed it and you found any value in this video to do like and subscribe. It does incentivize more material from our end. All of this is self-funded, are my own initiative on my own time. So it really does encourage me to produce more. And then if you were able to find any value in this, also may encourage you to share it with any person that you feel may find a value in this. Once all the bickering is set aside between the names and yada yada and so forth, ultimately we do it for to promote our sector within our country, to promote Canadian energy. That's the ultimate goal here, to demonstrate why Canada should be the number one destination worldwide for capital in regards to resource extraction. And I see material like this as easiest to onboard international investors, especially investors down in the US that may be seeing this video as they start to transition and look for low decline assets up north to their northern neighbors. They can find names like this and are onboarded much more easily and be able to better digest the story. So I hope you enjoyed it, and I look forward to share with you segment C tomorrow. All the best. Take care. Until next time.